Chris Woods, he's a strategist with CLSA. It's a top brokerage firm. CLSA is starting its annual India conference in Delhi today. That's the conference beginning. We'll cut across to Chris Woods addressing the press, and then, of course, okay, all right. I think let's listen in for a quick bit, coming right back.
To the left. Stop?
Just come back.
Okay. So hello everybody. I've given a presentation to investors for the CLSA forum this morning where I reiterated a positive view on the Indian market. My formal view on Asia and emerging markets this year has been that investors should be neutral in Asia and emerging markets in a global portfolio. But what I've been saying is that investors should be overweight Asia and emerging markets if they have the ability to deviate from the benchmark significantly to make a meaningful overweight in India. So in my own relative return portfolio, I am nearly 3 times overweight India. And in my long-only portfolio, which is 25 stocks in Asia, I have more than 40% in India. So these are meaningful bets on India. In my view, India today is by far the most promising story on a 5-year view in Asia and emerging markets. I think there continues to be a happy coincidence that the economic cycle in India was bottoming anyway when Mr. Modi secured his convincing electoral victory. My base case that an investment cycle will resume in India in the next 2 years. I also believe there's potential for meaningful cuts in interest rates in India during 2015. And the other positive for India clearly is the decline in the oil price, which is benefiting India probably more than any other major emerging market. So for all these reasons, I remain extremely constructive on India. India also represents significant attractive diversification for international investors. India has nothing to do with the quantitative easing, zero interest rate policies in the Western world, in the G7 world, which are distorting financial systems, distorting economies. And it also has very little to do with China, which is in the process of a slowdown or adjustment as it moves from more investment-driven growth to consumption-driven growth. In terms of valuations, India is not cheap, but it's not stupidly expensive either. So I think the stars are aligned for India in the global equity universe. Otherwise, I'm expecting quantitative easing to continue in the world at large. In my view, the ECB will embark on significant quantitative easing in early 2015. The BOJ has clearly increased its own monetary quantitative easing policies in recent weeks, while my personal opinion is the US will not be able to normalize monetary policy next year in America as anticipated by the consensus. In my view, you are more likely to see a new QE program in America than you are to see a federal funds rate hike. But that's a short synopsis of what I said this morning in the presentation, and I'm happy to take questions.
My question is, you already 11% overweight over the MSCI allocation in your portfolio for India. How optimistic are you? Most of the experts think that we are in a multi-year bull run right now for equities in India. Do you also share that view?
Yeah, my base case is that India looks good for the next 5 years.
Okay, and you said that the valuations are not stupidly high. So, how much is the scope from current? Considering that earnings will also improve from here on, and also how much more fee multiple can you give to India?
No, the Indian market's overvalued today, if I'm wrong on my central assumption that a new investment cycle will resume in the next 2 years. If I'm wrong on that, then India is too expensive and my asset allocation's wrong. If I'm right that an investment cycle will resume, then I'm comfortable with the valuations. If India underperforms between now and the end of this calendar year, it's not a big deal because it's already outperformed so much. So Any meaningful underperformance in India, I will use as an opportunity to increase my allocation so I get to 3 times overweight the benchmark. So I'm currently at 18 percentage points in my relative return asset allocation for Asia Pacific ex-Japan. The benchmark is 7. Ideally, I would like to be at 21, but the market hasn't pulled back enough to allow me to get to 21. So in that respect, I would welcome a correction. But we may not get a correction because the foreign investors actually have not put that much money into Indian equities this year.
Sure. And if you look at your portfolio, your overweight financials, probably playing on the expectation that the investment cycle will pick up. If you get an opportunity if the market corrected, would you be upping your allocations to financial sector?
Well, no, that's a different portfolio because that portfolio is 25 stocks in Asia, which is not linked to a benchmark. And in that portfolio, I'm already over 40% in that portfolio in India. And in that portfolio, I already have 15 percentage points in Indian private sector banks. But what I'm saying to global investors, not dedicated Asia and emerging market investors, I'm saying to global investors they should make an off-benchmark bet in India. And I'm saying if they're only going to own one sector in India and the global investors have bigger liquidity constraints, then they should own the private sector banks.
And you said that there is no risk that you see for if the QE or the fund flow. Do you see any reason that the fund flows could reverse for India?
I think by far and away the biggest risk in India is nothing to do with QE or external matters, it's to do with the single man risk in India, because the reality is a huge amount of these investment hopes in India are focused on the new Prime Minister and his commitment to investment and growth. So in my view, the current Indian Prime Minister is by a long way the political leader globally who is most focused on investment and growth.
And but when would you be taking a call whether he's able to deliver on it or not?
Well, no, all the evidence I've seen so far makes it quite clear that he's totally focused on getting an investment cycle resuming in India. There was a period there about 2 months ago when the consensus was saying that the new government was not doing anything. In my view, that view was nonsense. All the evidence is that he's extremely focused on getting an investment cycle going, but he's not got he hasn't got a 3-month view, he's operating on a 5-year, 10-year view, and I'm expecting significant potential for foreign direct investment into India as well. 2 obvious countries where the Indian Prime Minister's been to try and attract foreign direct investment, I think are both promising. That, of course, is Japan and the US. So I've seen nothing since Mr. Modi came to power to cause me to question his commitment to getting an investment growth cycle going again in India.
But at the same time, the credit uptake is not picking up. So does that worry you, or
No, I'm not expecting a sudden pickup in credit growth. There is a technical issue in India banking where we have a legacy of NPLs and restructured loans from the previous cycle, much of it relating to infrastructure-related loans. And there is a question how the government central bank are going to address this. What would be very positive is some sign that they're going to force proactive restructuring and capital raising in the state-owned banks. If they do that, that capital raising would be an opportunity for investors to buy into these state-owned banks. But until we see that evidence, I would rather own the private sector banks.
And what about rate cuts? Do you expect that to happen?
Yeah, on the rate cuts, clearly the RBI does not want to be cutting rates too prematurely, because we've had a long period in India where inflation has been stubbornly high. But the latest evidence is that inflation's finally falling. There is a base effect early 2015 which could cause inflation to pick up. So that's presumably why the RBI is cautious about commencing rate cuts now. The other point is the RBI will be worried about US rate hikes next year, putting potential pressure on the rupee. But in my view is very simple. The longer the RBI remains on hold now, quicker rate cuts will come, the more quickly rates will fall later. So I'm firmly of the view that you take a view to the end of 2015 as opposed to the next 3 months, rates are coming down in India and therefore interest rate sensitive sectors should be owned. My own personal opinion is the US will not be raising rates next year, so that's why I have a different view from the consensus.
And one other reason that you talked about was softening crude prices. Crude prices coming off has also helped India. But do you see that the prices can further go up from here on, or do you see
Oil prices?
Crude,
yeah. No, I think you're being conservative. You should assume crude is around $80 level. But maybe it goes lower. But if in terms of the big emerging markets globally, be it China, Brazil, Russia, India, these are other big Indonesia, the fact is, of all these countries, India is the most positively impacted by the lower oil price.
And what about gold? Do you expect gold to go up?
I expect gold to go up strongly when the consensus realizes that the US cannot normalize monetary policy. For now, the consensus assumes the Federal Reserve is going to be raising rates next year, so the consensus has been selling gold. My base case is gold bottoms at the 1,1050 level some point next year. But that will be decided by US monetary policy.
So between gold and equities, how would you distribute your portfolio?
No, I mean, in terms of global equities, India is my favorite market on the 5-year view today. In terms of all global equities.
Hi, Dvesh Mishra from Bloomberg. Is there a target you'd like to share for the benchmark indexes in the coming 12 months?
And I haven't got a target, but my long-term target in India since 2003 has been the census and get to 40,000. That's a target I've had.
40,000 in the next 3 years?
No, I've had that target for 10 years. So I'm not changing that target. If we have another investment cycle in India, the Sensex will definitely get to 40,000. The issue is if we have another investment cycle. The issue is not the index, the issue is the investment cycle.
And also, how do you see foreign funds coming into our country?
I think foreign money will continue to come into the equity market and into the debt market, into the private equity market. So long as Mr. Modi is in power, foreigners will be willing to invest in India.